I have a copy of a ledger page from 1804. The ink has gone the color of weak tea, and the paper smells like a basement that has not been opened in a long time. The handwriting belongs to a French immigrant named Eleuthère Irénée Dupont, and the entry records the purchase of land along a creek in Delaware called the Brandywine. That single page is where one of the longest unbroken runs of family money in American history begins. And here is the part that bothers people when they first hear it. In more than 200 years, the DuPont family, as a family, has never once been forced to liquidate the heart of its fortune to pay an inheritance tax. Not when EI died, not through two world wars, not across roughly 8 generations. I want to be clear about what this is and what it is not. I am a researcher who reads old corporate filings, not your financial advisor. And nothing I say is advice for your situation. But the structure they used was hiding in plain sight in the public record the whole time. So why did almost nobody copy it? To understand the structure, you have to understand the money first, because the structure was built around a very specific kind of fortune, EI. Dupont arrived from France in 1800 with his father and a head full of chemistry he had learned under a famous scientist back home. He looked at the gunpowder being made in the young United States and decided, frankly, that it was terrible. So in 1802, he founded a powder mill on the Brandywine, and within a generation, the DuPont mills were supplying the United States government. Wars are good for a powder company in the coldest possible business sense. And by the time the Civil War ended, the family was wealthy. By the early 20th century, after a reorganization led by three cousins, the firm had grown into one of the largest industrial enterprises in the country. I want you to sit with the timeline for a second, because the timeline is the thing most people never grasp. This was not a fortune that arrived in one lucky decade and then got managed. The powder mills ran on the Brandywine for generation after generation. Fathers handed the work to sons. Cousins married cousins and stayed in the same valley. The family did not scatter to different cities and lose touch the way most families do after 2 or 3 generations. They stayed concentrated, geographically and financially, in one place around one business, and that concentration is the soil the whole structure grew out of. You cannot build a multi-generation wall around a fortune if the family that owns it has already drifted apart. The DuPonts never drifted, and that was a choice as deliberate as any legal document they ever signed. Now think about what that fortune actually was. It was not cash sitting in a vault. It was ownership. It was shares of a company held by a growing crowd of relatives who were all descended from the same Frenchman. And ownership of a family company has a specific brutal weakness when somebody dies. The government wants to tax the value of what got passed down. And if the wealth is locked inside company stock rather than sitting in a bank account, the heirs can be forced to sell pieces of the company just to pay the bill. Sell enough pieces, often enough, and the family slowly loses control of the very thing that made them rich. That is how most fortunes quietly end, not with a scandal, with a tax bill that has to be paid in shares. The family that built its life around gunpowder understood pressure better than most. And in 1915, they made a move that answered the pressure. They created a company whose entire job was to own the family's stake in the family business. It was called Christiana Securities Company, named after a small settlement near Wilmington. On paper, it was a holding company. In practice, it was the early American version of something the very rich now pay enormous fees to build. It was a family office wrapped inside a corporation with one purpose: keep the ownership of the dynasty together so that no single death, no single heir, no single tax event could break it apart. The antagonist of this entire story is the estate tax, also called the inheritance tax, and Christiana Securities was the wall the family built against it. So let me name the structure plainly, because the names matter and people throw them around carelessly. There are three pieces, and they work as a set. The first piece is the single family office. That is simply an organization with real staff whose only client is one family. It manages the investments, keeps the records, co-coordinates and accountants, and plans for the day each generation hands off to the next. It is not a bank. It does not take outside clients. It exists to serve one bloodline across time. The second piece is the family holding company. This is the legal body that actually owns the assets. In the DuPont case, that was Christiana Securities, and what it held was an enormous block of stock in the operating business, and later in General Motors. Instead of 200 cousins, each owning their own scattered handful of shares, the cousins owned shares of Christiana, and Christiana owned the big block of the real company. The wealth was consolidated into one container. The third piece is the trust. Trusts are arrangements where assets are held by a trustee for the benefit of named people, often children and grandchildren who are not yet born. Layer trusts on top of the holding company, and you create a chain of ownership that can be designed to pass control downward across generations in an orderly way, governed by documents written long before anyone needs them. Put those three pieces together, and you get something that behaves very differently from a normal estate. The family office is the brain, the part that thinks and plans and remembers. The holding company is the body, the single container that actually holds the assets so they cannot be picked apart one limb at a time. The trusts are the nervous system, the set of rules that carry instructions from the people who wrote them down to the people who will inherit decades later. A family that owns its wealth this way is not betting on any one heir being wise. It is not betting on the next generation getting along. It has written the plan into the legal bones of the thing so that the structure keeps working even when the people inside it argue, even when they die young, even when they would rather spend than preserve. Now contrast that with how a normal wealthy person owns things. A successful individual owns his business directly in his own name. He owns his shares directly. When he dies, every one of those assets is counted as his personal estate, valued on the day of his death, and taxed accordingly. His heirs inherit a tax problem along with the wealth. If most of the value is tied up in a company that is hard to sell quickly, the family is squeezed. They may have to sell the company, or borrow heavily against it, or sell to outsiders who do not care about the family name. Individual ownership means the fortune is exposed fully at every single death. The family structure changes the math. Walk through it slowly. When a DuPont died, what did that person own on paper? shares of Christiana Securities. The big underlying block of the operating company was owned by Christiana, not by the individual. So the death of one cousin did not put the core fortune on the auction block. The thing being passed down was a stake in a holding company that just kept holding. And because trusts often held those shares for the benefit of the next generation, in many cases the assets were already positioned to flow downward under rules set years earlier, rather than landing as a sudden personal estate to be valued and taxed all at once. Succession became a planned handoff instead of an emergency. I want to be honest about the legal ground here because this is where conspiracy talk usually creeps in, and there is no conspiracy. A holding company is a completely ordinary legal entity. Corporations have been allowed to own shares of other corporations for as long as there have been corporations. Trust law is centuries old, older than the United States itself, rooted in English courts that wanted to let one person hold property for the benefit of another. None of the three pieces was a secret. None was illegal. None required a special favor from a senator. The family simply combined ordinary tools, paid for excellent lawyers, and applied patience that most fortunes never have. The structure was published, regulated, and visible to anyone who read the filings. So here is the catch, and it is a real one. This blueprint only works at scale. To justify a single family office with real staff, a real holding company, and a web of trusts that must be maintained for generations, you need a fortune large enough that the cost of running the machine is small compared to what it protects. Lawyers, accountants, trustees, and administrators all cost money every year, forever. For a family worth hundreds of millions or more, those costs are a rounding error. For a family worth a few $100,000, the costs would eat the fortune alive. The DuPonts could afford the wall because the wall was cheap compared to the kingdom behind it. Hold that thought, because by the end, I will show you the smaller version regular families actually can use. But first, did the wall really hold? It held for 62 years. Christiana Securities operated from 1915 until 1907, and across those 6 decades, it did exactly what it was built to do. It sat at the center of the family's wealth, owning a controlling block of the chemical company, and for much of that time, an enormous position in General Motors that the family had acquired in the automaker's early years. Think about what passed over those decades: the First World War, the crash of 1929, the Great Depression, the Second World War, the entire post-war boom. Through all of it, generations of DuPonts were born, came of age, and died, and the core ownership stayed consolidated inside the holding company rather than being scattered and sold off death by death. Compare that to what was happening to ordinary wealthy families during the same decades. The federal estate tax in its modern form had arrived in 1916, just 1 year after Christiana Securities was formed, and over the following decades, the top rates climbed steeply, eventually reaching levels that could claim a very large share of a big estate at death. For a family holding its fortune directly in individual names, every death during those years was a potential disaster, a moment when a chunk of everything could be owed to the government in cash the family did not have. The DuPonts had built their container before the storm even started. While other fortunes were being thinned out one funeral at a time, the family in Delaware kept its block intact inside a company that simply did not die when its individual owners did. A corporation has no funeral. That is the quiet genius of the thing. Consider the General Motors piece specifically, because it shows how the consolidation worked in the real world. The family, through its companies, had built one of the largest single ownership stakes in GM during the years when the automaker was growing into a giant. Holding a position like that inside a corporate structure meant the family controlled an immense amount of value without each individual heir personally holding and personally being taxed on slices of it. When you keep a block that large together for that long, you preserve not just money, but influence. The family had seats at the table of two of the most important industrial companies in the country at the same time, and they kept those seats across generations. Put a number on the patience involved, because the number is the point. 62 years is longer than most companies survive. It is longer than most marriages last. It is longer than the careers of nearly everyone who set the structure up in 1915, which means the people who built the wall did most of their building for the benefit of grandchildren they would never meet. That is the part that separates dynasties from lottery winners. A lottery winner thinks in years. A merely rich man thinks in his own lifetime. A dynasty thinks in generations it will not live to see, and it is willing to pay lawyers and accountants every single year, decade after decade, to maintain a structure whose payoff lands long after the founders are gone. The DuPonts treated the holding company the way they treated the powder mills, as something to be tended and handed on rather than spent. Roll, old hands placing a deed into a younger pair of hands, warm light. The arrangement was so large and so concentrated that the federal government eventually pushed back, not on the inheritance question, but on the matter of one company controlling a giant share of another. After a long legal fight that ran for years, the courts ordered the family's interests to unwind the General Motors holding, and the family distributed those shares out to its members over a period in the early 1960s. Even that unwinding was managed, staged, and orderly rather than a panic fire sale. Then, in 1977, Christiana Securities itself was merged into the main chemical company, and the holding company chapter formally closed. But notice what had already been accomplished. For 62 years, the structure had carried the fortune through every storm of the 20th century without an inheritance tax ever forcing the family to break itself apart. The wall did its job and was retired, not breached. That is the dynasty version. Now let me show you the opposite, because the contrast is the whole lesson, and most people live the opposite. Picture a regular family that did well. Maybe they built a business worth a couple of million, or they owned land that quietly became valuable, or they ran a farm for 40 years. The founder owns everything in his own name, the way almost everyone does. He never built a holding company. He never funded trusts. Maybe there is a simple will, maybe there is nothing at all. He assumes his children will just sort it out when the time comes. Then he dies, and the trouble starts immediately. Every asset is now counted as his personal estate and valued at the date of death, if most of the value sits in the business or the land. The family has a problem with no easy answer. There is a tax bill, or there are legal costs, or there are siblings who want their share in cash, and the wealth is not in cash. It is locked inside the thing that cannot be sold in a single clean piece. So the family does what unstructured families almost always do. They have a fire sale. They sell the business to a competitor for less than it is worth because they need the money fast. They sell the land to a developer. They sell to outsiders who feel nothing for what the family built. I have watched versions of this happen more times than I can count, and the pattern almost never changes. There is rarely a single villain. There is no greedy outsider scheming to take the farm. There is only a clock, a tax form, and a family that owns the wrong kind of asset at the worst possible moment. The deadline arrives whether the family is ready or not, and a business that took 40 years to build gets sold in 40 days because the calendar does not care how hard anyone worked. Often the buyer is a competitor who has been waiting for exactly this moment because professionals know that an estate under pressure is a motivated seller. The family gets a fraction of the real value. The competitor gets a bargain. And within a year, the name over the door has changed, and the employees have new bosses. And it fails for a reason that has nothing to do with how hard the founder worked. It fails because the wealth was owned the wrong way for the moment of transfer. Individual ownership puts the whole fortune on the table at every death, with no container to hold it together and no plan written in advance to guide the handoff. The DuPonts removed that single point of failure on purpose, decades before it could hurt them. The unstructured family walks straight into it every generation, and each time a little more of what was built gets sold off to pay for the lack of a plan. The money does not disappear because the family was foolish. It disappears because nobody built the container. So how does a person who is not worth hundreds of millions actually use any of this? Let me be careful here. I am not your attorney, and the right answer depends entirely on your state, your family, and your numbers. So the names and figures below are general illustrations, not a recommendation for you. With that said, the principles scale down further than most people think. At the very top, the full single family office is its own world. Most professionals who work in this field will tell you that a dedicated office for one family generally starts to make sense somewhere around $100 million or more simply because of the cost of running it. Below that, but still substantial, families often join what is called a multifamily office, which is a firm that runs offices for several wealthy families at once and splits the cost among them. A common rough threshold people cite for that kind of service is somewhere around $5 million in investable assets, though every firm sets its own minimum. That is the shared version of what the DuPonts built alone. For an estate that is meaningful but smaller than that, the same logic shows up in a simpler package. A very common combination is a family limited liability company paired with a trust. The family LLC acts as the small scale version of Christiana Securities. It is the container that holds the business or the property, so that family members own membership interests in the company rather than owning the underlying assets directly. The trust sits alongside or above it to direct how those interests pass to the next generation. It is the same three-part idea: holding company plus trust plus a plan, scaled to a kitchen table fortune instead of a dynasty. The person who builds this for you is an estate planning attorney, and that title matters. Not a general lawyer, not a salesperson, an attorney whose specific work is estates and trusts, ideally one licensed in your state and willing to coordinate with a tax accountant. Drawing up a basic family LLC and trust combination is the kind of work that commonly runs from a few $1,000s into the low tens of thousands, depending on complexity, which is real money. But compare it to a fire sale that costs a family a third of everything they built. The cost of the plan is almost always smaller than the cost of having no plan. I started in a basement with a ledger page that smelled like time, and I want to end somewhere closer to home at your own kitchen table. The lesson of the Ponts is not that they were richer than you, though they were. The lessons is that they decided more than a century ago that the wealth should be owned the right way for the moment it would have to be passed down. And then they built the boring legal container that made it possible. They chose the structure over the fire sale. That choice was available in the public record the entire time, and it is still available in smaller and smaller versions, all the way down to a single LLC and a single trust written by a good attorney. If this opened your eyes even a little, do the one thing that actually compounds. Subscribe so the next chapter finds you, because I keep pulling these old structures out of the record one family at a time. And in the next one, I want to take you somewhere the DuPonts would have recognized instantly. We are going to look at the Waltons, the family behind the largest retailer on earth, and the six-layer structure they have reportedly used since 1953 to move an almost unimaginable fortune downward without it ever landing as a single taxable estate. The DuPonts built one wall, the Waltons built six. I will see you there.